Okay, so next what I want to look at is the measure of a company's book value of their equity compared to their market value of their equity. So when I say book value of a company's equity, what I'm looking at is the book value of their shareholders' equity on their balance sheets. But one thing that I want to highlight with a company's balance sheet is when I look at the value of equity on their balance sheet, it's looking at that initial issuance of their shares, and it records the cost at that initial issuance date of those shares. So any transactions that occur in the market and any increase in the company's share price in the market aren't captured as a value on the company's equity side of their balance sheet. And we want to look at then the company's market value of their equity and compare their book value to their market value to understand the mechanics of the company and the increases in their values based on that. So when we calculate book value per share, what I'm looking at is the company's book value per share available to their common shareholders. So how I'm going to calculate that is by looking at the stockholders' equity on the company's balance sheet, and I'm going to subtract out the value of any preferred stock. So remember that when I look at preferred stock on a company's balance sheet, companies can issue preferred stock and it has a guaranteed dividend rate or rate of return attached to it. But those shareholders they're different than your common shareholders. Your common shareholders get any of the excess returns for the company or any of the residual income left for the company. Think of it as after I pay off all of my claims to my creditors and my preferred shareholders. So I pay my interest expense to my creditors, I pay my preferred dividends to my preferred shareholders, and any income that's left for the company at the end of the period is available for their common shareholders, either via the company taking that income and reinvesting in the business to grow the business or pursue acquisitions, or by taking that income and paying dividends to their common shareholders. So to calculate the book value per share, I'm going to take their stockholders' equity minus the value of their preferred stock, and I'm going to divide it by the number of common shares outstanding. So this is going to give me the book value per share on the company's balance sheet, and then I want to compare that to the company's market value per share. The company's market value per share is going to be essentially their market capitalization, which is just the number of common shares outstanding times the current market price, and that's going to give me the market capitalization or the value that the market, the public, is putting on my company. So if I look at Apple, recently hit a market capitalization of $1 trillion. The market is putting a value on the equity of Apple at $1 trillion. And think of the equity of the company as the net assets. If I go back to my balance sheet equation, my balance sheet equation says that a company's assets equals their liabilities plus their equity. If I take my assets less my liabilities, that equals the equity of the company or the value of the company after paying off my creditors. So a company will want to look at an investor will want to look at what's the value of my market value compared to my book value, and investors can look at that to see if a company might be over or undervalued. So for example, if a company has a low market price to book value per share, so the level of their market capitalization to the level of their book value of their equity, if that's low, it could represent a market opportunity. So the company's shares or market cap could be undervalued. It could be a good opportunity for an investor to buy the shares cheap. And once the market corrects itself to the stock price that the company is actually worth, the investor can make some pretty good returns on that company. It could also mean that there's simply something fundamentally wrong with the company. So if you have a low market price to book value of your company's equity, it means that the market capitalization of your company is quite low. It means that there's not a lot of investor confidence or excitement to invest in your company, and it could mean that there's something wrong with your company or your company is trending downwards in terms of growth and profits. Conversely, if you have a high price to book value, it means that your market capitalization is really high compared to the book value of your equity. It could mean two things. It could mean that your stock price, your market cap, is really overpriced. It's too high. It's going to correct itself at some point in the future to get down to a more appropriate level. So you could lose money as an investor in that company. But it could also mean a really attractive investment for investors to look at because it means that there's a lot of investor confidence in that company's share price and investors invest in company share prices, they think the share price is going to continue to go up in the future. So we'll look at an example with Amazon in a little bit, but Amazon is an example of a company has had great returns in the stock market for its investors, and it has a really high price to book ratio, which is okay for a company like Amazon because they're overperforming the market. So book value of your equity is going to differ from the market value of your equity for two things. So like I already mentioned, the book value of your equity is looking at that initial issuance price of your company's shares and doesn't account for any of the increase in the value of your market shares or the price of your company going forward. And it doesn't account for certain things that are just missing off of your GAAP balance sheet as a result of certain GAAP rules. So for example, remember that GAAP reports your assets at historical costs. You depreciate the value of your property, plant, and equipment. If you're certain companies that has a lot of internally developed intangible assets, you won't have a lot of asset value on your balance sheets for your patents or your brand values. If you think of a company like Apple or Facebook, there's a lot of internally developed intangibles with that company that are just missing off of the company's balance sheet. So I would definitely expect those companies to have a much higher market capitalization on their equity than what the book value of their equity or net assets are, because they aren't able to record a lot of assets on their balance sheet. So if I look at the stock market as well, keep in mind your stock price for your company reflects future performance expectations for where investors think your company is going to go. So if you have a high market to book ratio for your equity, it could just be really good because investors expect a lot of profits, a lot of future revenue growth for your company, and that's why they're pricing your market price or your market capitalization to be really high. So for a benchmark, the median market price to book value of a company's equity is about 2.5 to 3. So what I want to look at is an example of a company like Amazon that has a very high market to book ratio when I'm looking at the value of the company's equity. And we'll look at an example of a more normal company to see the difference between the market cap and the book value of the company's equity. So I'll do an example on the light board to go over this in a little bit more detail. So I wanted to go over some calculations for looking at a company's market value of their equity compared to their book value of their equity. So I'm calling it market to book ratio here. You can also see it referred to as price to book ratio. The slides will also you can look at a company's market price per share over the company's book value of equity per share. And when I say per share, I'm looking at common shares outstanding. But a way to shortcut it if we're looking at calculating this for companies based on their financials is I can look at a company's value of their market capitalization. So that's the value that the market is putting on the company's equity. And I'll look at this for Amazon. So for Amazon, their current market capitalization is almost $1 trillion. It's $978 billion. And if I look at the book value of their equity, it is currently at $27.7 billion on their balance sheet. For doing this calculation, you want to look at the book value for your common shareholders. So you would subtract out any value for preferred shares, but Amazon doesn't hold any preferred shares. So if I look at their equity on their balance sheet, it is made up of two components. It's made up of their common stock value, and it's made up of essentially their retained earnings. So when we look at the retained earnings, just to put some clarity around this, remember your retained earnings are your accumulated profits. And when you look at your retained earnings, it's after you paid out any expense or cost of debt to your creditors, and it would be reduced for, if you're looking at the book value of your equity, you're just trying to get at what's the residual return left over for our shareholders, and that's going to be any of the value or including the value of our retained earnings. So when I look at this $27.7 billion, it's a lot less than the $978 billion for two reasons. One of them is that when I look at the book value of Amazon's equity, their common stock account is being credited for the amount that the shares were initially issued at. And if I look at when Amazon did their IPO, at their IPO date, they issued their shares for $18 a share. So if we look at their common stock, it's worth a lot more in the market. It's over $2,000 a share, so the value of that share price has increased a ton. And those transactions, so market-to-market participant transactions that increase the value of their share price, is not going to affect the balance sheet or affect this 27.7 book value of equity on the company's balance sheet. So when we look at what also does affect this, it is the retained earnings. So a company that's been really profitable, I would expect to see their share price and their market capitalization increase a ton. But for a company like Amazon, they haven't had a lot of book earnings or net income. They don't have a very large amount of retained earnings because they have a lot of expenses every year in order to generate future profits. They're still growing a ton, spending a lot of R&D, so it's not allowing them to have a really high retained earnings. All that is to say is that a company like Amazon is going to have a really high market to book ratio. It's going to be much higher than the average of about 2.5 to 3. Theirs is currently 35. It could look like the company is really overvalued and their price might be too high, but for a company like Amazon, it's not, just because they have so many growth streams going forward. So to look at it for some other companies that have more of the average market to book ratio, we can look at an example with Walmart. So if I look at Walmart's market capitalization, it's currently $284 billion. And the book value of equity on their balance sheet is currently 77.9. So for Walmart, their price to book ratio is about 3.9. So keep in mind that most companies' price market to book ratio is a bit higher than normal just because so many companies' market capitalizations and share prices, the market overall is priced a bit higher than normal. If I look at another example for a competitor to Walmart, we can look at an example with Target. So Target currently has a market capitalization of $47 billion. And they have a book value of equity on their GAAP balance sheet of 10.9, which gives them a market to book ratio of 4.3, so a little bit higher than Walmart. One thing I just want to point out here is that certain transactions can affect the book value of a company's equity as well. So just something to keep in mind when we're analyzing the market to book ratio is remember that when you repurchase shares of your stock, it decreases equity on your balance sheet, so it's decreasing your denominator in this ratio. And that's why you can see a company like Walmart, they can have a lower value for their book value of their equity, and it can affect or manipulate this ratio. So there's never going to be a perfect price to book ratio that you want to look at for a company. You just want to see how it trends over time. It could mean that a company's overpriced, could mean that a company's undervalued. It's just something that you want to look at and see how the company's doing compared to their competitors, how they're doing over time, and also just see if there's certain transactions like stock repurchases or dividends that reduce your retained earnings, reduces your equity. See if those things are also manipulating if you're doing a trend analysis or a year-over-year analysis for this type of ratio for a company.